The country would rather not have to pay $100,000, but they'd rather, how do you do that? You hire Americans.
Amid headlines about tariffs, lawsuits, and fears of mounting economic damage, President Donald Trump has made yet another bold move, one that critics warn could push billions of dollars in investment away from the United States. In the middle of this storm, he stood at the White House and unveiled a pair of executive orders. The first created the so-called Trump Gold Card, a $1 million shortcut to U.S. citizenship. The second slapped a $100,000 fee on skilled worker visas, known as H-1Bs. What was sold as a patriotic defense of American jobs is already being read abroad as a signal that Washington is becoming unpredictable, costly, and harder to trust.
The president signing a proclamation that now requires this $100,000 annual fee for this H-1B visa for highly skilled foreign workers. Now, this could be a huge blow to big tech firms that rely heavily on highly skilled foreign workers to fill key roles.
For decades, the H-1B visa has been one of the few channels for companies to bring top engineers and scientists into the United States. Yet approval rates already hovered near 20%. By adding such a steep fee, Washington is turning a tool meant to strengthen America's role in technology into a barrier that deters both workers and employers. Trump frames this as protection for U.S. graduates, but abroad it looks like a government sending mixed signals to the very innovators it claims to need. The headline says protecting American jobs, but the reality is different. With supply chains shifting and nations competing for capital, raising the cost of entry risks making the United States look less like the obvious place to build, hire, and invest. The controversy deepened in early September when Immigration and Customs Enforcement carried out a raid at Hyundai and LG Energy Solution construction site in Georgia. More than 300 South Korean engineers and technicians were detained. None were charged with a crime. Images of workers in chains and handcuffs returning to Seoul with only government-issued plastic bags for belongings spread quickly across global news networks.
So now the question turns to, what are all these companies going to do, Brian, that are here in South Korea, that have future projects in the United States? They do not want anything like this happening to their employees.
From the perspective of companies, they will be concerned about disadvantageous treatment or facing difficulties when they're building factories in the United States. That could probably have a significant impact on direct investment in the U.S. in the future.
The South Korean president warned openly that such treatment of investors and employees could have a significant impact on future foreign direct investment into the United States. For families watching their sons and fathers escorted off planes, the sense of humiliation was real. And for executives preparing to spend billions building clean energy plants in America, the signal was equally powerful. This was not the image of a country welcoming partners. It was a warning that rules could shift overnight and allies could be treated as adversaries. When paired with the H-1B crackdown, the picture grows clearer. The United States is telling the world that entry for both capital and talent is conditional, costly, and politically volatile. Far from securing American jobs, this combination risks driving opportunity elsewhere. North of the border, Canada is positioning itself as the reliable partner in a turbulent time. The federal government has rolled out investment tax credits for clean technology, battery supply chains, and advanced manufacturing. These include a 30% credit for clean tech equipment and additional support for EV supply chain projects. Canada is also using its advantage in abundant clean electricity and a workforce of skilled graduates to attract new factories and labs. At the same time, Ottawa has tightened reviews of foreign investment in sensitive sectors such as critical minerals. That balance allows Canada to offer a fast track for projects that create jobs in renewable energy or high-value manufacturing while showing caution where national security is at stake. For global investors, the comparison is becoming obvious. Where the U.S. now risks reputational damage and operational delays, Canada is selling stability, predictability, and partnership.
Trump's intention was to safeguard employment for American workers. Yet the ripple effect of high visa fees and headline-grabbing raids is that trusted allies now hesitate. Instead of encouraging new investment, these moves suggest that America is closing its doors at the very moment when supply chains are being redrawn. For Canada, this is not just a window of opportunity. It is a chance to capture projects that might have landed south of the border. By presenting itself as steady and welcoming, Ottawa is turning the turbulence in Washington into momentum for its own economy. Trump's visa gamble was meant to strengthen the United States. The reality is that it risks pushing global capital and talent northward, where Canada stands ready to receive them.
We turn now to the growing level of economic uncertainty surrounding the North American auto industry. The big three are navigating a new era as they deal with the impact of President Trump's tariff.
They had initially said likely a $4 to $5 billion hit throughout the year to their profit.
America's auto sector was supposed to thrive under new tariffs. The White House promised factories humming again, with Detroit's Big Three leading the charge. Yet the reality feels very different. Rising costs are squeezing margins, supply chains are uncertain, and investment decisions are slowing down. While U.S. production struggles to find stability, Canada looks increasingly attractive. With CUSMA protections still in place, vehicles built north of the border can reach American buyers without the same risks. It raises a compelling question. If the next billion-dollar assembly lines are not built in Michigan or Ohio, could they be rising in Ontario instead? Suppose GM, Ford, and Stellantis decided to expand in Canada. What impact would that have on the North American auto supply chain? Let's find out. Just recently, the fragility of America's investment climate was exposed at Hyundai's new electric vehicle battery plant in Georgia. Immigration agents detained nearly 500 specialized workers, halting construction on a $7 billion project. Costs mounted, deadlines slipped, and an effort meant to create thousands of jobs turned into a cautionary tale. For automakers, this was a wake-up call. Tariffs already push up prices for steel, aluminum, and imported parts. Now, immigration crackdowns are adding another layer of risk, making it harder to find and retain the skilled labor that factories need. Instead of an open door, executives see a moving target. Canada offers a different picture. Under CUSMA, Canadian-built vehicles keep their privileged access to the U.S. market. Ottawa's more open immigration approach also makes it easier to bring in skilled workers when shortages emerge. On top of that, Ontario has attracted billions in battery and EV supply chain projects, creating a ready ecosystem. The contrast is clear: instability on one side of the border, predictability on the other. Now imagine that General Motors, Ford, and Stellantis each decide to expand in Canada instead of the United States. A modern assembly line employs 2,000 to 3,000 workers and produces around 200,000 vehicles per year. At an average factory gate price of $30,000 per car, that is about $6 billion of output per plant each year. If all three shifted their next projects north, the United States would lose 6,000 to 9,000 direct factory jobs. Because every assembly job supports several more in suppliers, trucking, and local businesses, the wider loss could exceed 50,000 jobs nationwide. The missed production would be worth roughly $18 billion annually. For Canada, those numbers translate into gains. 6,000 to 9,000 new factory jobs would anchor communities in Ontario and beyond. When the multipliers are counted, the economy could add 50,000 to 60,000 jobs. Canadian auto output, worth about $14 billion only a few years ago, could surge by another $18 billion in a single year. What Washington's policies push away, Ottawa's stability could pull in. The lesson is straightforward. Tariffs that raise costs and immigration policies that shrink the workforce may not bring factories back. They may push factories across the border. Canada's appeal lies not in offering something flashy, but in offering certainty. For the U.S., the choice is whether to adjust course. Stable trade rules and practical workforce policies could restore confidence. For Canada, the opportunity is to build on its CUSMA advantages and ensure its labor and supply base can meet demand. Factories go where the path is clear. If America continues to close doors, then the next wave of North American auto investment may roll north, and the engines of Detroit's future could be heard humming in Ontario.
It is now clear that the U.S. Wants to go ahead with tariffs against countries in the world, and that many countries right now are not necessarily abiding by the free trade rules. And we're at a moment of rupture with that free trade system that we have known for decades. So we have to be ready, because of course it comes with disruption.
This disruption calls for a bold new approach.
Canada is facing one of the toughest trade environments in decades. New U.S. tariffs have shaken supply chains and left thousands of workers anxious about their future. But instead of bowing to pressure, Prime Minister Mark Carney has stepped forward with a bold plan. In Toronto and Ottawa, he unveiled a sweeping set of measures that he described as nothing short of a new approach to protecting Canada's economy. The message is clear. This is not about waiting for relief from Washington. This is about building a shield strong enough to withstand the storm and give Canadians the tools to stand tall. At the heart of this new approach is a collection of policies aimed at workers, businesses, and critical industries. The government has introduced a formal Buy Canadian mandate, turning what was once a best efforts guideline into a legal obligation for federal contracts. This move is designed to keep procurement dollars circulating at home and to provide a guaranteed base of demand for domestic suppliers. Alongside that, a $5 billion strategic response fund has been created to support sectors hit hardest by U.S. tariffs. That includes steel, aluminum, copper, softwood lumber, and the auto supply chain. The auto sector, facing a 25% tariff, will also see relief from a pause in the federal electric vehicle mandate. The previous target required 20% of new light-duty vehicles to be electric by 2026. With sales already down 35% year over year in June, according to data highlighted in CTV reports, the pause gives automakers breathing room. For workers, the shield includes a reskilling package designed to help as many as 50,000 people move into new roles. Training will be paired with job-matching support, recognizing that tariffs have disrupted not only exports, but also domestic hiring. And for farmers, particularly canola growers facing crippling Chinese tariffs, Canada is committing $370 million in incentives to turn crops into biofuels for the Canadian market. Each of these measures is a piece of armor intended to protect livelihoods while reshaping the economy for long-term resilience.
Well, look, the scale and cost of what Trump is doing becomes more apparent with each new announcement. It's billions and billions and billions in supports and restructuring, and thousands and thousands and thousands of Canadians losing their jobs. So today, it's the building blocks for a support program from which to launch this wide-scale industrial restructuring.
U.S. tariffs are hitting sensitive sectors from autos and metals to lumber and farming. Small manufacturers face higher import costs after duty-free exemptions were removed, while canola growers are squeezed by Chinese duties. Instead of freezing in place, Canada is using this pressure to reset. Pausing the EV mandate gives the auto sector breathing room. Reskilling funds help workers adapt. And trade diversification toward Europe and Asia signals that Canada refuses to be cornered by a single market. This is what makes the shield vital. It is not built on the hope that tariffs vanish, but on strengthening Canada's base so the economy can endure whatever comes next. Taken together, the new package is less about immediate relief and more about endurance. By strengthening procurement rules, investing in workers, and cushioning key industries, Canada is building a shield that could withstand years of turbulence. Unlike a dramatic counterpunch, this shield works quietly, reinforcing the economy from the inside out. Trump's tariffs are designed to force allies into concessions, yet Canada's strategy may turn the pressure back on Washington. U.S. businesses and consumers are already shouldering higher costs, and as Canada diversifies its markets, the leverage of American tariffs weakens. The outcome is still uncertain, but the trajectory is clear. Canada is not folding under pressure. It is building resilience that could outlast both this wave of tariffs and the political cycle that produced them. In the face of disruption, Canada's shield is more than protection. It is a declaration that the country will chart its own course, even in the shadow of its largest trading partner.